3 weeks ago, something caught my attention that simply didn't add up. At first glance, it seemed like background noise, a minor detail most would scroll past without much thought. But the more I dug into it, the more unsettling it became. And now, after the document that arrived on my desk yesterday, it's clear this wasn't mere noise. It was a warning siren. Let's roll back for a moment. On December 18th, 2025, the world's largest silver ETF, iShares Silver Trust, trading under the ticker symbol SLV, reported holding approximately 920 million ounces of silver. That figure alone cemented its status as one of the most dominant players in the silver market. Then, 2 days later, on December 20th, a small asterisk appeared in their daily holdings report. It was nothing alarming, just a footnote referencing a routine SEC compliance review, the kind of bureaucratic note accountants pay attention to, but most investors tend to overlook. I shrugged it off as well. Then came January. On January 3rd, SLV's reported silver holdings plunged by 41 million ounces overnight. No press release accompanied this drastic drop, just a vague statement citing redemptions. 4 days later, on January 7th, another 38 million ounces disappeared. Still no concrete explanation. By then, the pattern had become impossible to ignore. And then, yesterday, January 10th, the missing piece of the puzzle surfaced. The document in front of me is an SEC enforcement filing dated January 9th, 2026, labeled as an emergency action. And to be absolutely clear, this is not some routine audit hiccup. This is fraud. According to the Securities and Exchange Commission, SLV, the fund that had claimed to hold 920 million ounces of silver in secure vaults worldwide, could not account for an astounding 387 million ounces. The missing metal isn't misfiled or delayed in transit. It is completely unaccounted for. The SEC has now ordered SLV to liquidate its fund by February 15th, 2026. That means selling whatever physical silver remains in its possession, distributing the proceeds back to shareholders, and shutting down operations permanently. There will be no extensions and no room for negotiation. Before diving deeper into how this debacle unfolded and what it means for the silver market at large, here's a quick resource for those seeking detailed insights beyond surface-level commentary. I've created an educational guide called the Silver Insider Toolkit, designed to help identify early warning signs in the physical silver market before major price shifts occur. It covers key indicators like inventory changes, stress in the futures curve, delivery demand pressures, and policy adjustments, the very framework I use for analyzing situations like these. You can find the link in the description. Now, let's get back to the document itself. The SEC filing spans 14 pages and bears the header United States Securities and Exchange Commission, Division of Investment Management, Emergency Enforcement Action, and Fund Liquidation Order. The subject line identifies the iShares Silver Trust under its NYSE ticker symbol SLV. The opening section outlines the timeline. On December 15th, 2025, part of regular compliance procedures under the Investment Company Act of 1940, SEC, officials launched a physical verification audit of SLV or S reported silver holdings. SLV8's stated position was that its assets comprised physical silver bullion stored in both allocated and unallocated accounts managed by major custodian banks. On that date, SLV reported total holdings of 920 million troy ounces. Between December the 16th and January 5th, SEC auditors worked alongside independent third-party vault inspectors to conduct thorough physical inspections at custodian facilities located in London, New York, and Toronto. They meticulously reviewed serial numbers, scrutinized bar lists, and confirmed allocations of silver bars. What they uncovered was damning. Only 533 million ounces could be physically located and verified as belonging to SLV. This leaves a staggering discrepancy of 387 million ounces. The filing explicitly states that this shortfall cannot be attributed to logistical delays, timing differences, or clerical errors. There is simply no evidence that the silver matching SLV's public reports exists in any capacity. The SEC's initial assessment concludes that this constitutes material misrepresentation of assets, a clear violation of federal securities laws. Language: pause and take a moment to absorb this. The world's largest silver ETF once claimed holdings of 920 million ounces, yet regulators discovered only 533 million. This means a staggering 42% of the silver never actually existed. Here's where it becomes both fascinating and troubling. This wasn't a case of someone sneaking in and making off with silver bars. Instead, it was an inevitable consequence of how modern bullion banking operates. The problem lies in the framework of SLV, which depends on custodian agreements with major banks like JP Morgan Chase London and HSBC London. Within the system, silver is categorized into allocated and unallocated accounts. Allocated accounts designate specific bars with distinct serial numbers stored separately for SLV. In contrast, unallocated accounts provide SLV only with a claim to silver without reserving specific bars. Essentially, in unallocated practices, the custodian banks hold a pooled reserve of silver to back multiple claims. While SLV's prospectus asserts that most of its holdings are allocated, an audit revealed the opposite. 62% of its holdings were unallocated. The crux of the issue with unallocated silver lies in its reliance on fractional reserve banking principles. Custodian banks issue more claims to silver than the physical stock available, assuming that simultaneous redemption requests won't occur. This system operates smoothly until it doesn't. Such a collapse became evident when the soaring silver prices between 2024 and 2025 led prominent institutional SLV shareholders to demand physical redemption. This placed immense pressure on custodian banks to convert unallocated claims into allocated physical silver bars, something they proved incapable of doing. The required silver simply wasn't available. Instead of confronting the deficit, the banks resorted to moving silver between accounts to maintain the illusion. The deception unraveled completely when regulators conducted surprise inspections across multiple vaults, ultimately revealing that 387 million ounces existed only as accounting entries, not as physical assets. The accompanying SEC investigation unearthed even graver details. Internal emails disclosed that BlackRock Fund Advisors, SLV's manager, had been aware of these discrepancies since June 2025. Risk officers had flagged significant issues regarding custodians' inability to provide bar lists that matched SLVES claims. However, instead of informing investors, BlackRock management decided to keep quiet, hoping future purchases would bridge the gap. They didn't. The shortfall was concealed, with management failing to disclose crucial information, a lapse the SEC concluded constitutes securities fraud. Additionally, custodian banks were found liable for creating phantom silver claims, essentially committing fraud as well. In response, the SEC immediately prohibited further issuance of new SLV shares as of January 10, 2026. Although existing shares remain tradable, the fund itself is effectively frozen. BlackRock has been ordered to liquidate all remaining physical silver, 533 million ounces, and distribute the proceeds proportionally among shareholders by February 15th, after which SLV will be dissolved and delisted once and for all. The underlying reality is stark. Current SLV shareholders do not own the previously claimed 920 million ounces of silver, but are limited to claims on roughly 533 million. The remainder has always been fictitious. This brings us to the market implications of this unprecedented liquidation event. According to SEC data, liquidating 533 million ounces over 35 days mandates selling around 15.2 million ounces daily. For context, global daily trading volume averages just 8 million ounces. This means SLVAS liquidation will flood the market with nearly 190% more supply than normal every single day during this period. To find a comparable event, one would have to recall the Hunt brothers liquidation in 1980, which involved selling approximately 200 million ounces over several months and resulted in an 80% price collapse in silver. However, this liquidation exceeds that volume by over double and will occur in a fraction of the time. The SEC modeled possible scenarios to project outcomes. Under an orderly liquidation featuring negotiated block sales, the average sale price per ounce is estimated at $41, ending with a market price near $38 by completion. A standard market liquidation scenario sees average prices drop to $30 with silver ultimately trading at around $27. In a worst-case panic scenario where investors exit en masse, the average price could nosedive to $21, briefly plunging to lows of $17 per ounce. This isn't conjecture. These estimates come directly from the SEC's economic modeling. SLVAS collapse signals the end of paper silver illusions confronting the hard truth of physical scarcity, a reckoning that will inevitably ripple far beyond the single ETF. What happens next hinges on how markets, institutions, and retail investors respond when faced with the harsh reality. Hundreds of millions of ounces they thought they owned never truly existed. At this point, we've moved beyond assumptions and entered the realm of the SEC's economists conducted multiple scenarios to evaluate the potential outcomes of the current situation, and their findings are both direct and concerning. They concluded that Scenario 2 is the most likely scenario, given BlackRock's resources, the enforced timeline, and historical market behavior in conditions of stress. Their calculations point to an expected terminal price of $27 per ounce for silver. With silver currently priced around $80, this translates to a staggering 67% drop. These figures aren't speculative guesses or hyperbole from online commentators. They represent rigorous analysis from impartial regulators with no agenda to sensationalize. According to the SEC's report, 533 million ounces of silver will need to be liquidated within just 5 weeks. a Herculean task. Once that process begins, the market's downward momentum is all but inevitable. However, this massive liquidation is only one aspect of a much larger crisis that comprises three interconnected disasters, each fueling the others. The first crisis is what experts have termed a redemption death spiral, which is already in progress. Between January 3rd and January 9th, the SLV, iShares Silver Trust, experienced redemptions amounting to 79 million ounces. About 9% of its reported holdings evaporated within just 6 trading days. What's more alarming is that these redemptions are accelerating. On January 3rd alone, 41 million ounces were redeemed, followed by another 38 million on January 7th. These staggering outflows aren't driven by retail investors selling through trading apps. Institutional investors are pulling out capital en masse. The reasons behind these redemptions appear rooted in rumors spreading within the precious metals community about potential discrepancies in SLV's holdings. Large-scale investors reportedly began analyzing bar lists and comparing them to physical availability, uncovering gaps and inconsistencies that raised red flags. The result? A wave of redemption started even before the SEC publicly addressed the issue. Now that the regulator has issued its findings, even more institutions are likely preparing to exit en masse. Here lies the core issue. BlackRock simply cannot meet all redemption demands. The total available physical silver amounts to just 533 million ounces. If institutional investors holding an aggregate greater than this figure request physical redemptions simultaneously, BlackRock will face no alternative but to deny some requests and implement forced cash settlements instead. This development would spark widespread panic, feeding a vicious cycle as investors realize that redeeming shares for actual physical silver is no longer possible. Consequently, everyone will rush to sell their shares, attempting to cash out before valuations plummet further. This so-called race to exit creates predictable consequences. A collapse of SLV share prices well below the net asset value, NAV. Typically, SLV trades in lockstep with actual silver prices, but during a liquidation event, these shares trade at a discount due to reduced investor confidence. The SEC has estimated this discount could reach as low as 10 to 20%. In numerical terms, this means that if silver prices hit $27 per ounce, SLV shares could fall as low as $21 to $24. Investors face dual blows, first from the overall collapse in silver prices, and then again from this steep discount. Under these circumstances, BlackRock has preemptively outlined its strategy: suspend redemptions altogether and only permit trades through secondary markets. While this decision may shield BlackRock from being forced to produce physical silver, it doesn't possess. Secondary market sales will generate enormous selling pressure on SLV shares. With share creation halted and redemptions frozen, SLV will essentially become a closed-end fund. This makes prices entirely subject to market sentiment, an inherently precarious state wherein logical valuation models may no longer apply. The second crisis stems from legal implications that promise years of fallout and financial turbulence. According to SEC estimates, SLV accounts include approximately 275,000 individual shareholders and around 3,800 institutional holders, almost 279,000 investors in total, who collectively believed they held claims on 920 million ounces of silver. The reality presents a sobering discrepancy. Only 533 million ounces exist, leaving a shortfall of 387 million ounces. At current market values, this gap signifies approximately $31.7 billion in potential investor losses. This financial chasm virtually guarantees what could become the largest class action litigation case in the history of precious metals markets. Plaintiffs will likely file claims against major financial players like BlackRock Fund Advisors, JP Chase, HSBC, and other custodian banks for allegations including fraud, negligent misrepresentation, and breach of fiduciary duty. Settlement costs are estimated between $8 billion and $22 billion, yet resolution will take years, and reputational damage for these firms begins immediately. For BlackRock, managing approximately $10 trillion across its funds, an exposed fraud in one of its high-profile ETFs severely undermines trust across its broader portfolio. Similarly, custodians such as JP Morgan and HSBC face potential destruction of credibility within bullion banking circles. Physical premium expansion will be limited. The phantom 387 million ounces never existed, but the real 533 million ounces are very real, and they're being sold aggressively. The result is brutal but simple. Paper silver collapses because of fraud. Physical silver collapses because of forced liquidation. Both happen at once. There's no magical safe harbor in the middle of a fire. The third crisis may be the most dangerous of all because it extends beyond SLV entirely. The SECS investigation revealed that custodian banks didn't all issue unallocated silver claims only to SLV. They issue them to many institutional clients. JP Morgan's unallocated silver claims in London are estimated between 900 million and 1.2 billion ounces. HSBC's range from 600 million to 750 million ounces. Physical backing for these claims is estimated at just 300 to 400 million ounces combined. That's a fractional reserve ratio of roughly 3.1. For every physical ounce, 3 paper claims exist. SLV's collapse exposes this structure publicly. Other institutions, pension funds, sovereign wealth funds, hedge funds, endowments will demand allocation or delivery once they realize what they actually own. Custodian banks cannot satisfy those demands. Some institutions will sue. Some will try to liquidate claims at any price. Some will demand delivery and trigger defaults. Every path leads to more selling pressure and more volatility. The SEC assessment is clear. The unallocated bullion system is systemically fragile. SLV didn't cause the weakness. It revealed it. This isn't just about one ETF. It's about the entire London bullion banking model built on fractional reserves. Before I walk you through the liquidation timeline, let me pause for a moment. If this analysis is helping you understand what's really happening in silver markets, subscribe to the channel. Turn on notifications. This kind of information doesn't come from headlines or press releases. It comes from digging through enforcement filings, modeling forced liquidation flows, and understanding how plumbing actually works. Most channels won't show you bearish scenarios because they're unpopular. I'm showing you reality. Uncomfortable, inconvenient, but necessary. Now, the timeline. According to the filing, liquidation begins immediately. In the first week, January 11th through 17th, BlackRock CK sells roughly 120 million ounces, primarily through large block sales to institutional buyers. Prices fall from $82 to around $68. That's the best week, relatively speaking, because buyers still believe there's value. Week 2, another 110 million ounces hit the market. Institutional interest fades, discounts widen, and prices slide toward the mid-50s. By week 3, institutional buyers are largely exhausted. BlackRock CK sells into dealer channels and exchanges. Prices fall into the low 40s. Week 4 is desperation. 90 million ounces sold under deadline pressure. Prices sink into the low 30s. And by the final week, the remaining 113 million ounces are sold at whatever bids exist. That's how you reach $27. No drama, no conspiracy, just math, deadlines, and too much metal chasing too few buyers. By the time the final ounces hit the market, there will be no mystery left, only exhaustion. The last phase of this liquidation is the ugliest one because everyone knows the clock has run out. Prices don't fall because sellers want to be generous. They fall because buyers know they can wait. In the final days, BlackRock CK has no leverage. So the mandate is absolute. Everything must be sold before February 15th. That Amos Y, the SEC's own analysis, shows the final leg dropping silver from the low 30s to roughly 27, another 16% decline in just days. The last ounces are always the hardest to move, and the market is very aware that hesitation is rewarded. Buyers step back, bids disappear, and discounts deepen. That's how you get from $82 to $27 in 35 days. Not slowly, not politely, relentlessly. Now, let Yes talk about a topic that many people are clinging to for emotional comfort: physical premiums. This is where reality tends to offend marketing narratives. The SEC's assessment is clear. Physical silver usually trades at a premium to spot because of fabrication costs, dealer margins, and supply bottlenecks. Right now, those premiums are substantial. American Silver Eagles carry roughly a 32% premium. Generic rounds are around 24%. 10 Oz bars, near 18%. Even 100 bars still carry double-digit premiums. During this liquidation, those premiums don't protect you. They evaporate. Why? Because dealers suddenly have access to distressed wholesale supply. Large bars from SLV vaults will be available at spot or even below. When dealers can source metal cheaply and in size, they have no incentive to pay elevated premiums for retail products. The SEC projects that premiums collapse within 2 to 3 weeks. Eagles fall from 32% to around 8%. Generic rounds drop to roughly 4%. Bars go to zero premium or negative. By the end of January, the damage is largely done. Let's translate that into real-world pain. Imagine an investor who bought American Silver Eagles in December when spot was $80. With a 32% premium, they paid about $108 per ounce. By late January, spot is $30 and the premium is 8%. That puts the total value around $35. That's a 68% loss, worse than the spot decline alone. Physical doesn't cushion the blow, it amplifies it. You lose on price and on premium at the same time. Dealers love to say premiums protect you in a crisis. That's true in shortages. This is not a shortage. This is a forced liquidation. Different animal, different outcome. Now, let's turn to mining stocks because This is where optimism tends to go to die quietly. According to the filing, the impact on silver miners is devastating. At $82 silver, the average primary silver miner has an all-in sustaining cost around $22. Margins are enormous. That's why mining stocks have been trading at peak valuations. At $27 silver, those margins collapse to about $5 per ounce. That's a 92% compression. Many miners don't survive that. The SEC estimates 30 to 40% of primary silver mines shut down. Equity valuations reflect future cash flow, not nostalgia. When EBITDA collapses by more than 90%, stock prices follow. Primary silver miners typically trade at 10 to 20 times EBITDA. Reduce the denominator, and the math gets ugly fast. The filing projects 80 to 95% declines in primary silver mining stocks. Diversified miners with silver as a byproduct fare better, but still fall 50 to 70%. Names people treat as long-term silver exposure. First Majestic, Hecla, Pan American could see share prices drop 85 to 95%. This isn't leverage working in your favor. This is leverage turning around and asking for its money back. If silver falls 67%, mining stocks don't fall 67%. They fall 90%. That's how operational leverage works when prices move against you. Now, let's address the argument you're about to hear everywhere. The silver community will say this is bullish. They'll say SLV fraud proves paper silver is a lie and everyone will rush to physical. It sounds logical. It's also wrong. The SEC addressed this directly. Yes, SLV fraud undermines confidence in paper silver, but SLV holds 533 million ounces of real physical silver, and that silver is being dumped into the market. That supply overwhelms any increase in demand from investors fleeing ETFs. Second, investors who lose money in a fraud don't usually double down immediately. They exit the sector entirely. Trust takes years to rebuild. Third, 533 million ounces equals roughly 2 to 3 of annual global mine supply. That volume hits the market in just over a month. Physical buyers simply cannot absorb that at current prices. Prices must fall until new buyers appear. The SEC estimates flight to physical demand of 50 to 100 million ounces against liquidation supply of 533 million ounces. That leaves a surplus of over 400 million ounces, 4 to 8 times more supply than new demand. That's not a bullish imbalance. That's a price reset. Physical and paper prices fall together. There is no decoupling. The idea that physical silver rockets while paper collapses sounds good in theory. In this scenario, it doesn't survive contact with arithmetic. History supports this. The filing references the 2013 audit scare around GLD. Questions emerged about whether the gold actually existed. GLD responded by publishing bar lists and allowing audits. The gold was there. The conspiracy theories died. GLD survived. SLV is different. The audit didn't vindicate it. It convicted it. A closer parallel is Lehman Brothers. In 2008, Lehman claimed strong assets. Audits revealed fiction. Liquidation followed. Creditors received pennies on the dollar. SLV is the precious metals version of that story. This isn't a conspiracy being proven right. It's fraud being confirmed. And confirmed fraud ends one way: liquidation. So how do you verify this is real? You don't take my word for it. You watch the market. Watch SLV shares, outstanding. They should decline steadily as liquidation proceeds. Watch SLV's price versus net asset value. Discounts should widen. Watch the silver price path. If prices slide towards $68 by January 17th and $54 by January 24th, the model is tracking. Watch London physical premiums. Good delivery bars, trading at or below spot, confirm wholesale oversupply. Watch custodian banks. Any announcements about unallocated account restructuring or redemption suspensions tell you the contagion is spreading. Markets don't lie, narratives do. Prices and volumes tell the truth without emotion. Which brings us to the uncomfortable conclusion. If the SEC enforcement action is real, and if liquidation proceeds on schedule, holding silver in any form is value destructive over the next 5 weeks. Paper silver holders are liquidated at distressed prices. Physical holders lose on spot and premium. Mining stockholders face near total wipeouts. This isn't about belief, it's about exposure. You have a choice. You can believe the filing is real and act accordingly, or you can believe it's exaggerated and hold on for the squeeze you think is coming. But you cannot do both. The timeline is explicit. The liquidation begins January 11th. The target is February 15th. The projected price is $27. By January 17th, silver near $68. By January 24th, near $54. By January 31st, around $41. By February 7th, low 30s. By February 15th, $27. Watch the prices. Verify the data. Trust the market, not comforting stories. The SEC has shut down the largest silver ETF in the world. 533 million ounces are being sold. 387 million ounces never existed. This is the largest precious metals fraud ever documented. I can't promise every detail will unfold exactly as written, but I can tell you the math is sound, the incentives are clear, and the timeline is brutal. If this filing is accurate and you hold silver into February, you're accepting the risk of losing 2, 3, or more of your capital in a month. You've been shown the document. You've been given the markers to watch. If the market confirms them, the outcome won't be a surprise. It will be a consequence.